Once the market comes to break this level, it is suggesting to us that it wants to what? Go down. So if it goes back to retest at that very level where it broke, at that very level where the break in market structure happened, and it rejects off it and starts to drop, that point is referred to as a flip zone or a breaker or support turned resistance. We will go to live chat and I'll show you examples. I think this is GBP JPY. It's one of my favorite pairs. Very good. This is a bullish market. But what time frame is this? It's 4 hour. I would have to switch. I like to do the illustration on bigger time frames. Let me switch to a weekly or monthly time frame and show you something. Let me go back. I want a very good example so you'll understand what I'm saying. And I think I have a very good example here. So let me zoom in and let me show you exactly what I was explaining. I may have to zoom out and zoom in interchangeably because the chart is, I've gone back to 2013. So if I don't zoom out and zoom in interchangeably, you may not see the whole picture. Now, you can clearly see that this was one hell of a bullish move. Can you see it? How bullish the market was. One hell of a bullish move. Let me try to identify the swing lows and swing highs. This move started over here. This is what I was illustrating over there. Now look at something. You will not see it nicely drawn like I did in the illustration because sometimes market moves some way. So, but what I want you to identify, this is, let me key in the swing highs and swing lows so you get me very well. These are the swing lows and these are the swing highs. You can see it looks very close to what I was showing you. So look very well. So you can clearly see that this was a bullish market. It started over here. Swing high, pull back, swing low. Swing high, pull back or retracement, swing low. Swing high, 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 retracement, swing low. Swing high. Now see what happened over here. Very good. So you see, swing high, retracement, swing low, swing high, retracement, swing low. It continued happening. Now, bear in mind, this is a monthly time frame. So this is a lot of price action and this is a lot of money. From here all the way to the top here is how many pips? Over 6,000 pips. But as a retail trader, I don't think you would have stayed in this market for this long. That's more or less positional trading, which is done more often by the institutions, the big institutions. So look at the structure. Swing high, swing low, 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 swing high. Now see what happened later. Can you clearly see that this swing high, let's focus on the most recent swing high in this bullish move. Can you clearly see that this swing high got broken? If you can see that this swing high clearly got broken over here. And when I say it got broken, what I mean is price traded through that swing low and closed below it. Yes, you cannot see that it got broken. Price traded through that swing low, this swing low, and closed below it here, forming another swing low. Now we don't have higher lows, we have lower lows. See what is happening. When it broke that swing high, it went back to retest it. So as a trader, let's say, when did this happen? This break, it happened on 31st August 2015. So let's say on 31st August 2015, you realize that the market had broken an important swing low. Immediately, it should suggest to you that the market wants to reverse. But the fact that it is suggesting to you that the market wants to reverse, it does not mean you should just enter and sell over there. To get a proper confirmation, we usually have to wait for price to go back up there to retest that swing low that got broken. Then that retest will be our entry. So look at what happened. After it broke it and came back to retest it, can you clearly see that there was a change in market direction? There was a change in market direction. The market started going down. It started going down. Then it started forming what? Lower highs and lower lows. Remember when I was talking about the bullish market structure? I said each high is higher than the previous high and each low is higher than the previous low. You get me? Each high is higher than the previous high and each low is higher than the previous low. Now, after it broke the market structure, look at what happened. Now, each low is lower than the previous low and each high is lower than the previous high. So this is clearly a change of trend, and that happened because the market broke structure over here. So this point is what we refer to as a break in market structure, abbreviated as BMS. You can also refer to it as a flip zone or support turned resistance. Some people also call it a breaker. All of these terms are used to describe the same situation. So it's very obvious. After the break in market structure came, price started to what? Drop. So there's no way you should see this and still be looking for buy setups. Once the market structure is broken, it's suggesting to you that the market now wants to trade down. So you have to be looking for sell setups. Now, like I was saying earlier on, we are teaching you the components of our strategy. So right now, we are teaching you the components. When we finish looking at each and every one of the components, we will now show you how to combine them and do analysis, starting from the bigger time frames and scaling your analysis down to the 15-minute time frame to get a perfect entry. So don't be confused. We looked at trading cycle, we looked at candlestick patterns, we looked at support and resistance. We also look at price and time analysis, and we look at the daily cycle again into detail. Then now we will show you how to start your analysis from the monthly time frame down to the 15-minute time frame where you can clearly see the daily cycle and then execute your trades intraday. So you'll be making profit on a daily basis. I think it's the best way for retail traders to trade. So you either trade intraday cycle or you swing. You can also scalp, but I don't really like scalping. It makes me feel nervous. That's just by the way. This is a bullish. Let's now look at how a bearish market structure looks like. Now, when we say it's bearish, obviously it's what? Coming down. So you have market doing something like this. So what we are considering is what happened from here to here. Forget about this for now. Let's concentrate here. Let me do my markings once. With a bearish market, these swing highs once again are acting as what? Resistance. These swing lows are acting as support. So look at what is happening. Now, these movements are called impulse swings. Some people call them impulse leg. They mean the same thing. So if you look at what is happening, the market is dropping from above like rain. It's moving in this direction. It's bearish. It's moving downwards. So you can see that the market creates a swing high, pushes down, forms a swing low, retraces up. Now, the up movements, the short-term up movements are called pullbacks or retracements. You can use any of those terms. They mean the same thing. When it goes in the opposite direction, it's called a retracement. So this is it. Swing low, swing high, swing low. Okay. Swing low, retracement, swing high. 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 So this structure will continue forming. The swing low, swing high, swing low, swing high. It will continue forming until there's a reversal or until there's a break in market structure. Then when that break in market structure occurs, it is suggesting to you that the market wants to what? Go up. Now, this was the initial move, a bearish move. But once the market structure is broken, it is suggesting to you that now price wants to go up. So if you look very carefully with this example, which is the market structure of a bearish market, the market is forming. Look at this low. Let me use the numbers again. This is 3. This is 4. These ones are on the same level. Good. So look, this is a swing low. This is a swing low, swing high, swing low, swing high. So if you look, let's concentrate on the swing lows for now. You realize that swing low 2 is lower than swing low 1. Swing low 3 is lower than swing low 2. Swing low 4 is lower than what? Swing low 3. What does that mean? It means in a bearish market, the market creates lower lows. We call them lower lows because each low It's lower than the previous low. So if you look at this low, it's lower than this one. If you look at this low, it's lower than this. And if you look at this low, it's also lower than that. And it's the same thing for the highs. So we have lower lows and what? Lower highs. Please take good note of these terms. If you understand market structure, you have to understand market structure, so it will help you know if a market is bullish or bearish. You have to know. So in a bearish market, we say the market is forming what? Lower lows and lower highs. And like I already explained, each low is lower than the previous low. Each low is lower than the previous low. That's why it's called lower lows. And each high is lower than the previous high. Each high is lower than the previous high. That is why it's called what? Lower highs. So as far as the market is concerned, this structure will continue to form until there's a break in market structure. This is our break in market structure. This is it. So you realize that swing high 4. Now bear in mind, the swing highs are acting as what? Short-term or intermediate-term resistance. So you realize that this move up here broke swing high 4. So once the move breaks swing high 4, it is telling you that there's a break in market structure. And a break in market structure is suggesting to you that the market now wants to go where? In the opposite direction. So once there's a break in market structure, most of the time, price will come back to test that very level where it broke and continue. Other times, it will come here. It will return to origin where the whole move started. Sometimes it will go past here and come here. So we call that return to source or return to what? Origin. Origin because that was where the bullish move originated from. So if it goes back there, it is called a return to origin. But I can say 7 out of 10 times, this is what usually happens. It will come back to test the very level it broke and continue going up. So the level that got broken is resistance turned support. It was acting as resistance over here, but once the market broke it and came back to retest and continued going up, it is no more a resistance level. That level is now a support level. So it's called resistance turned support or a flip zone or a breaker. This is what I'm talking about. The portion I've highlighted. This is what I'm talking about. So you can clearly see from this illustration that there was an impulse move up that broke this swing high. So later price came back to do what? Retest it, got rejected over there, then it continued going up. So this point should be your point of interest. Now, as you learn from us, you will learn how to catch the trade right from the reversal. So sometimes, if we don't miss the trade and we are on time, we catch it over here where the move started. Then when it breaks this level and comes back to retest, we enter more positions. I'll show you 2 examples of that. I remember very well because I took those trades. I'll show you an example on GBP USD that happened somewhere in June. It was a very sweet trade. Sweet, so sweet. Those type of trades are sweet, I'm telling you. This is what happens when there's a break in market structure. So that level is referred to as a breaker, a flip zone, or resistance turned support. You choose what you like. I like to call it breaker because it sounds simple to me. So I refer to it as a breaker. So you should train your eyes to be able to identify these areas because there are areas, high probability areas, where you can take really, really good trades from. So that is it for a bearish market structure. And this is where we refer to as the break in market structure. So this is where your focus should be. As far as the bearish market structure is, this is what I'm talking about. So that's a bearish market structure. The structure got broken over here, then the market reversed and started going up. So let's connect the dots. Swing low, swing high, swing low, swing high, swing low, swing high, swing low, swing high. Let me zoom in and then continue. Swing low, swing high, swing low, swing high. Something very interesting happened over here. Now look very well. This was a very bearish market. That went down for how many pips? Plenty money. Over 6,000 pips. Plenty money. So this is our swing low. This is our swing high. So let's look at something. Okay, swing low, swing low. Now look at something. Can you clearly see that the market was forming lower lows and lower highs? This low is lower than the previous low. This low, I think there's another one here I could have included. This low is lower than the previous low. This low is lower than the previous low. Now this low and this low are on the same level, but this low is also lower than what? The previous low. Now let's look at the highs. This high is lower than the previous high. This high is lower than the previous high. This high over here is lower than this. This high is lower than this, and this high is lower than this. So this was clearly a bearish market. So in this market, you should only be looking for what? Sell opportunities, not buys. You don't want to be selling when the market is buying. It can turn you into a very miserable person when market mafias you. When you find yourself on the wrong side of the market, you enter the market, you are selling, then it keeps going up. You have to understand market structure. So you make sure when the market is bearish, you are selling, and when it is bullish, you are buying. So you don't find yourself on the opposite end. So there's a swing high here, market pulls down, swing low, swing high, swing low, swing high, swing low, swing high, swing low. You can even form a song with it, so you remember swing low, swing high, swing low, swing high. So you see that the structure continued until there was what? A break in market structure. Where is the break? Let me show you. This swing high got broken. That swing high got broken. This one. And what happened? Market came to retest. It was not a perfect retest because it went below it a little. It came to retest. And then it went up for how many pips? Assuming you entered this trade on the retest all the way up to here, how much would you have made in pip value? This is a weekly time frame. You would have made almost 2,000 pips upon break in market structure. So you see what happened? When it broke the structure, it went up for over 1,000 pips before it started to drop again. So this is typically how a bearish market looks like. And like I'm telling you, this structure will continue forming until we have a break in market structure. So this point where there was a break in market structure is our flip zone or resistance turned support or breaker. I like to call it breaker. It sounds simple and it sounds nice. This is it right here. I hope you can all see it. Can you clearly see the break, the retest? Then the market started going up. It didn't go up for too long, but it went up for over 1,000 pips before it started dropping. So you could have capitalized on this movement, the break and the retest. This was a daily time frame. So we are not going to have a long. So let me show you something. Just short term. This one wasn't a long bearish move, but then there was some bearishness. Look at what happened over here. I remember this a short-term bearish move. Swing high, swing low, swing high, swing low, swing high, swing low, swing high, breaking market structure. And still, since then, it's been going up. See, let me show you something. This one is just for short-term illustration purposes. I've zoomed out or zoomed in so you can all see very clearly. This was a swing high. So when a swing high or a swing low is broken, technically it is referred to as a what? Break in market structure. That's why I've drawn this horizontal line. I am anticipating that sometime in the future, price will come back to test that level and continue going up. So I'll leave it there till price comes there. So I'll see how it will react. So these are swing highs. These are swing lows. Now see what happened. Can you see that this swing high got broken? And by it getting broken, I mean price traded through it, came back to retest and gave us a nice rejection in the form of what candlestick is it? It looks to me like what's it called? Dragonfly doji. So this was a retest. And have you seen what happened ever since then? Price has been going up. So now see, the swing highs and swing lows have changed. Now we don't have lower lows, we have lower highs. Now this is unhealthy price action. When you see candlesticks of the same color following each other like this, like a battalion, it's unhealthy. So there's a big gap here that will be filled later on in the future. I'm giving you a trick or a clue. If you see candlesticks of the same color, whether they are bullish or bearish, following each other like this, there's a lot of imbalance here. So there are big gaps here that the market will come back later in the future to fill. That was just a bonus. But I was trying to explain this. So can you see, as soon as this swing high was broken, price came back to retest and then entered. So I caught this trade here. I remember very well because it was in July or June. I caught it over here, right here. This thing is called an order block. Those of you who fund big, I'll teach you order blocks. So if you want to learn order blocks, let me not say big. Let's reduce it. So a lot of people, I know a lot of you can fund $1,000. Some of you too are very rich. You can fund 20,000 and above. So you can fund 1,000 or even 500. I'll teach you how to identify order blocks. They are a very beautiful form of support and resistance that is used by the institutions. So I entered the trade here, took it up here. Once it broke this swing high and came back, I added more positions, still holding these positions here, and it went all the way up. And I got out here. So I closed this trade at this point. So imagine catching this trade here, taking it all the way here, and even entering on the retest. So let's calculate the number of pips I made. This was my entry right on top of this order block, all the way here. I made 740 pips on this trade. Very sweet trade. And I entered more positions upon the break and retest of this level, this swing high. So this is what I'm explaining. Practice the things we are teaching you. Look out for them. You see them. They occur each and every day on all the time frames. We say the market is fractal. When we say it's fractal, it means the pattern is the same on all the time frames. The things you see here on the daily time frame, you see them on 5 minutes, on 1 minute, on 1 hour, on monthly, on weekly. You see them on all the time frames. That's why we say price is fractal. So take note of these things and study them very, very well, so that once you go onto your chart and you see some of these patterns forming, you know exactly what to do. Let's see if we get an example of a bearish market structure that led to a break in market structure sometime later. Yes, there's another example here. So any swing high that gets broken, you should take note of it. That is why I have put this horizontal line here. Okay, that's why I've put this horizontal line here. I am anticipating that sometime in the future, price will come back here to that swing high that got broken. Then that swing high will act as support. Then the market will start going up. So if I get confirmation that this pair wants to drop, if I sell it, I'll come and take my profit here. It can get here and continue going down, but this is the safest place to exit because it was a break in market structure. It can get there and start going back up. You can't tell. So it's safe if you get out over there. Then you observe what happens. Then you know the next move to take. So if I get confirmation that this, and it looks like it wants to drop, if I get confirmation that it's going to sell, I'll sell up to here. Then I'll take my profit here and I'm out. This is good. I saw something interesting happening. Let's see something. Look at this drop. Look at what market did over here. You see, I've put a horizontal line here because it's an interesting point for me. There was a break in market structure over there. And over here too, there looked like there was a break in market structure. But I didn't place a trade because today is Friday. If I'm not in a trade, I don't enter trades on Fridays. Because Friday, the market is about to close. There's a lot of manipulation that goes on. But this looked like it wants to go up. Though it looked like it wants to go up, I didn't enter the trade because, like I said, it's Friday. Friday, there's a lot of fake moves in the market because it's about to close. So it's not a day you should be entering trades. If you are not already in trades from the previous days, Friday is not a very good day to be entering trades because they manipulate the market a lot on Fridays. So this is an interesting point to me because price did this. So look at this. Why here is of interest to me is because there was a break in market structure there. So if I'm buying gold, this is where I'll be looking to exit. If assuming I bought it here, this will be my exit at this break in market structure because that place, and that's why market was going wrong for you. Fridays, please, if you are not already in a trade from the previous days, I don't advise you to place trades on Fridays. So today I didn't place any trade. Fridays, there is a lot of, because it's about to close, there's a lot of funny movements in the market. So assuming I had bought this, which looks like it's in a buy zone for me, maybe somebody might think otherwise, but I think it's in a good buy zone. If today were, let's say, Thursday or Wednesday, I would have bought gold and I would have looked to exit over here, because that was a swing low that got broken. Look, this is a swing high. If you understand market structure, it reduces your error margin drastically. So please, this is a very important lesson. You have to understand it. So this swing high got broken over here. The market came down here to test this level. There's something here called a bullish order block. That's why it came back there. So it looks like it wants to go up to this place. So Monday, if I see this rectangle I have drawn over here, if it is respected, I'm likely to buy gold and exit over here. But if the market comes and closes below it, then it means the analysis has been violated. So I'll not think of buying gold yet until there's a gap down here that I'm expecting them to fill. So it can decide to come down and fill that gap before they go back up. But in any case, this is a break in market structure. So you should, when you are doing your analysis, you should take note of all the breaks in market structures and then mark them like I've done over here. Mark them, so when you come back, it's very easy for you to remember. So I know this is a break in market structure, so I should actually label it VMS. So in future, if price comes there, it's likely to find some short-term resistance there. In any case, gold is still very bullish. This was just a retracement, but gold is so volatile. Even its retracement can make you a lot of money. Let's calculate the number of pips in this retracement. It came all the way down here. You see, retracement keke over 2,000 pips. Gold is a beast. So if your account is small, don't joke with gold. It can mafia you, make you very miserable because it is extremely volatile. I'll be giving you pairs you can focus on if you have a small account, so that if you have a drawdown, it doesn't affect your account very much. But if your account is small, let's say you have $100, this is not something you should consider trading. Gold is very volatile. Those of you who be funding 10,000 and above, those 10,000 and gold, you can be trading gold. Your money is big. So if you apply risk management and you trade gold, you can make money. So this is the break in market structure. If it holds, price is likely to go up to find resistance at this break in market structure too. The market is almost closed. So, ladies and gentlemen, we have been talking about market structure and I've shown you quite a number of examples.